With another week wrapped up, we saw the latest US jobs report post a better than expected payrolls figure, but the lack of a revision to the prior 12K figure did have some wondering whether we're more likely to see a rate cut from the Federal Reserve. Well, we've got the US CPI coming up this week, so that should help markets in deciding exactly where they stand on that front. And we also see a raft of rate decisions coming from the likes of the RBA, from the SMB, the ECB, and the Bank of Canada. So a massive week ahead with a big focus on central banks and US inflation. So let's jump into it. These are the big ticket items according to Trading Economics. And you can see here that it kicks off really on Monday, which is relatively quiet, but the big figure comes out of China with the latest inflation rate. Of course, inflation essentially is nowadays being judged as a gauge of economic activity. Of course, if inflation remains low, it indicates that people are unwilling to pay any decent amount for goods that might be able to provide businesses with the opportunity to raise prices. You know, if you've got low demand, then you're unlikely to really start to force up prices. And you can see here, there's a forecast that we will see it rise actually to 0.5 from 0.3. Of course, still very low, but nonetheless, that could be a signal that potentially the Chinese economy is heading in the right direction. Then things start to warm up a little bit. On Tuesday, we've got the early morning here in the UK. Interest rate decisions from the RBA expected to remain steady at 4.35. But interestingly enough, whilst we are not expecting to see a cut from the RBA and we are expecting it from other central banks, in actual fact, I think it will be a really interesting one because by and large, the RBA are soon enough going to have to pivot. So we're going to have to start to see them really starting to change that narrative before too long. Then Wednesday, inflation data coming out of the US. Of course, by and large, the Federal Reserve does like to utilize the core PCE price index figure. But when we're looking at headline inflation, really it's that headline CPI number that everyone looks at. Expectation that we're going to see higher on both a monthly figure up to 0.3, but also on that annual figure up to 2.7. Core is also going to be absolutely key. It remains steady as things stand at 3.3. Is that going to be the case? And then looking further out, we've also got the likes of the Bank of Canada interest rate decision. We've got the SMB interest rate decision, and we've got the ECB interest rate decision. So plenty of volatility, in particular within the FX space, one would expect. So let's kick off with the US. And of course, that inflation metric on Wednesday is going to be really interesting. The reason for that, of course, is because we have seen this resurgence in fears around a possible rebound in inflation. The move into a Donald Trump presidency means that we've got someone in charge that, by and large, I think is not going to be holding back. I think he's going to look to push forward, grow the economy at a rapid clip. And that's great, right? But that's ideal at a time when we don't have inflation over and above target, and the potential resurgence in inflation could have significant knock-on implications for monetary policy. So if we were to see a strong economy in the US but resurgence in inflation, that really would provide the basis for strong US dollar growth going forward, certainly in comparison to some of these other countries where the central banks are cutting rates and the economy is relatively weak. Elsewhere, we've got the PPI inflation figure on Thursday, and then we've got that initial jobless claims number on Thursday as well. So here is the breakdown for the core inflation. And look, I'll probably do a video that sort of drills down into this in it sort of from a deeper perspective. So it's just a couple of charts here, because if I did all of these topics in detail, then, you know, ultimately the video is probably going to be an hour long. So I'm just sort of pick and choosing some key ones here. And so first and foremost, we've got this US core inflation metric. You've got the CPI, so the core CPI, and the core PCE, of course. So PCE is the part that actually tells a more favorable story because it's standing at 2.8%. But the core CPI is at 3.3. Like we saw previously, markets are expecting it to stay that way. But look at this middle section, right? By and large, monthly inflation, in my mind, is more important than the year-on-year number. I mean, you know the year-on-year number, right? But whether year-on-year goes up or down is by and large going to be a result of what happens on the monthly time frame, right? So the year-on-year figure of, let's say, on this occasion, 3.3 doesn't tell you a story about whether that inflation is recent, whether it was essentially a year ago and it's soon enough going to drop out, whether it's consistent, or is it chunky in certain periods. So that month-on-month chart is really key. And what we can see here is the past 3 core CPI figures have been around the 0.3 mark. Now, the 2 that I've got marked on here, 0.28, and then the one in between in September, so around about 0.29. So essentially, you're looking at sort of 0.3 on a monthly basis. If you want to get back down to target, you need to get below 0.2 on a monthly basis. So what we saw in May was good, June, July, good, right? But aside from that, over the course of the last 12 months, you're looking at CPI that, aside from 3 months, has been running above the level required to get back down to target. And the fact that we've seen it over the past 3 months is a warning sign. That points towards a possibility that, yes, when we see these, we've talked about this for some time, when we see these chunky figures at the beginning of 2025 stripped out, so we'll see sort of January, February, March in particular, once we see them cleared out, there was a good possibility we see some really significant disinflation. That's only if we're seeing 0.2, let's say, on a monthly basis on the more recent figures. So if we see heavy numbers once again, as we're seeing now, it really points towards a possibility that we're not going to be getting down to target anytime soon. So the ability to drop back down towards that 0.2 figure is really key here. As we can see here, market's expecting another 0.3. So that essentially would be 4 0.3 metrics in a row. And of course, 0.3 is not where we need to be. We need to be below that 0.2 mark. So inflation's still running relatively hot in terms of CPI. And this report's probably going to show us exactly that. Now, in terms of market expectations, coming off the back of this non-farm payrolls report, we've seen a growth in expectations that the Federal Reserve will cut in December. You can see here that the interest rate decision from the Federal Reserve take place on the 18th of December. We're now looking at a roughly 90% chance that we cut. Now, that was more like 70% 24 hours ago. So certainly there's been a shift in narrative, and that should be good for markets. So, how are markets doing for the time being? Well, let's look first and foremost at the S&P 500. This chart highlights not only a long-term uptrend that we see on the daily time frame, but also this narrowing of this uptrend and the rally into this ascending trend line. Also, the top end of the Bollinger Band that we'll be able to. Oh, there we go. So we've also come in to this sort of top end of the Bollinger Band. So we're at an area that some could say is stretched. On the hourly time frame, though, we can see, by and large, it's a clearly defined trend. So, if we see a breakout from that trend and move down through the likes at the moment on your price swing low of 6033, that's when it starts to look like it could roll over. But we're not seeing at the moment. And the bulls are back in charge once again at the back of that payrolls release. So the bullish trend still does play out. And certainly if we are to see, a weak inflation metric, then that would really feed into this bullish narrative. But a resurgence in inflation and the knock-on implications for monetary policy from the Federal Reserve, not necessarily ideal when it comes to the likes of the S&P 500. And so, like I said, we're up around this trend line resistance. So we've sort of seen a nice move towards the upside. We could see a pullback if we see that inflation data coming out strong, but that's an if, right? I mean, quite frankly, markets are expecting 0.3 on a monthly basis. That already is stronger than we need it to be. But the trend is clearly defined. So until we see that trend reversing, the trend is your friend, and the trend is still bullish, as you see on the intraday basis, but also over the daily time frame as well. Next, let's take a look at what's happening in Australia. Australia is a really interesting one because it has been an outlier, right? You see many of these other central banks really preparing and enacting a new sort of dovish monetary policy regime, that pivot into rate cuts, just hasn't happened in Australia. And so that provided a sort of outlier against which other currencies and economies and central banks can be compared. But we have started to see inflation in Australia coming down, and it does provide the basis for us to think that they could cut rates before too long. As you can see here on Tuesday, the expectation is that we keep rates steady at 4.35. We've also got a raft of jobs data coming out on Thursday with the expectation that we see the employment change number improving up to 20K from 15.9, unemployment remaining at 4.1. But nonetheless, it's an interesting one to be following. And like I said, soon enough, they're going to have to pivot. And the pivot, by and large, doesn't look like it's going to happen this time around. December meeting, December the 10th, you can see just a 13% chance of a rate cut, according to the Icon platform and market pricing. But look further out, and in February, we can see 53% chance that we keep rates steady for that meeting. And therefore, it's essentially a coin toss when it comes to February. So this meeting, whether we see a rate cut or not, is going to be interesting for the way that they outline what the likeliness is for a rate cut in February. Now, interestingly enough, despite the fact that the RBA have been holding off, the likes of the Australian dollar and the New Zealand dollar have really been underperforming of late, both weakening pretty heavily, in part perhaps due to what's happening under Donald Trump, because we're looking at a move that by and large has been playing out quite significantly over the course of the post-election period. We can see here the election happened around about here in the US, and we've been seeing the Australian dollar weakening since. Now, this is the Aussie dollar against the Japanese yen. From a wider perspective, we can see that the trend is bullish, but certainly over the near term, we can see that we have been sort of rolling over and in a very clear-cut downtrend. You can see it in the hourly time frame. And when I prepped these charts prior to the payrolls release, we hadn't actually sort of broken lower. So we were looking for that. Ultimately, that's happened already. But nonetheless, we've got this near-term trend that has been very consistent in nature. But we do have these sort of questions still being asked with this sort of recovery phase that has been happening here. So in terms of this latest rebound, where do we stand from a fib perspective? Well, we're at the last bastion, that is the 76.4 Fibonacci level. On this occasion, that falls at 95.67. Heading down towards that level, that is going to be key. But certainly for me, I think this is an interesting chart. It's one where you want to follow it on an intraday basis. Be aware of that wider trend, of course. But we have a very clear-cut intraday trend. And if we were to break back up through resistance here, certainly if we have a relatively hawkish stance from the RBA, then that could provide the basis for a potential bullish move for Aussie yen. But until that happens, we're looking at a chart that has consistently created lower highs, lower lows. In actual fact, 96.8 is the latest swing low, with the fact that we've now rolled over once again. So certainly an interesting one to be watching out for, but the sort of interest rate differentials are going to likely shift before too long as the RBA moves away from this hawkish stance that it has held for some time now, despite the fact that we're seeing rate cuts abound for some of these other central banks. And finally, this is the outlook for both Canada and Switzerland. I mean, ultimately, we didn't see much from either of them beyond the interest rate decisions. I didn't necessarily want to miss them all out because I don't know that I'm going to do specific breakdowns for all of these. So I thought, let's take both of them into account. So first and foremost, Wednesday, we've got the Canadian interest rate decision, market expecting to see a 25 basis point cut down to 3.5%. And then notably, the Swiss expected to enact another 25 basis points worth of cuts down to 0.75. As you can see, very different level of interest rates over in Switzerland, and there's good reason for that. I mean, look at this breakdown in terms of Swiss inflation. If you look at that middle section, we were talking previously about the importance of looking at monthly inflation. So many of these figures in negative territory, right? So once that February number drops out, we're just going to be lower still. So certainly disinflation is more of a problem, and negative inflation, deflation is more of a problem than high inflation over in Switzerland, and therefore they have the grounds to be able to cut rates to their heart's content. That being said, they don't have much room to move into, quite frankly. You can't just continue to move deeper and deeper into negative territory. They're not in negative territory, but they're not that far away from it. And certainly, if you look at that annualized 6-month annualized figure at the bottom, minus 1.48, this stands in stark contrast to pretty much all of the major central banks, all of the major economies when it comes to inflation. Now, this is the outlook in terms of, let's do the S&B first. So this is the outlook for the meeting. And interestingly enough, there's no guarantee that they will cut this time around. 53% chance. There's no guarantee on how much we'll cut by. My mistake, 100% chance, but it's the degree to which they're going to cut by. 53% chance of a 50 basis point cut down to 0.5% from 1%, and then 47% chance of a 25 basis point cut. Now, I would say what's interesting about this is the example that we just saw from the RBNZ, right? So it was a question mark. Do they do 50? Do they do 75? And we're thinking, well, ultimately, either of them are over and above what we're seeing from most of the other central banks. But the fact that they did 50, markets have to price a possibility for either of them, right? So right now, markets are pricing 53% chance of a 50 basis point cut, 47% chance of a 25 basis point cut. That means if they cut by 25 basis points, you might think, oh, well, they're cutting rates, we're going to see a weak Swissy. In actual fact, you're seeing the unwinding of those that thought we were going to see a 50 basis point cut, and you end up often seeing the strengthening of the currency. So if we see that 25 basis point cut, we could actually see some strength coming into play for this currency. But as you look further out, essentially markets are expecting them to move down to that zero threshold and just remain there. Essentially, there's a sort of outlier possibility that they move into negative territory. But so the possibility of strength comes more not necessarily from the differential between their interest rates and other central banks, but more so the case that they're pretty much going to be done. And then you start to see other central banks moving while the S&B is essentially keeping rates steady. So that's where we could potentially see it playing out in the future. But this time it's really interesting because essentially it's a coin toss between a 25 and 50 basis point cut. The same kind of thing that we're seeing over in Canada. You can see 48% chance that we're down to 3.25 and 52% chance that we're down to 3.5. So again, a very similar picture for the Bank of Canada. If you look further out, what's the rate of easing, considering that we're seeing for some of the other central banks, they're talking about, like the Federal Reserve, or we're just going to see it every other meeting, every quarter, things like that. Well, the Bank of Canada, we're expecting to see them cut rates this time, probably the next time if we don't do 50 at this meeting. Beyond that, down to 3% in March. Beyond that in the April meeting, 40% chance that we see them cut once again. So it starts to slow a little bit at the back end of Q1 as to not cut at each meeting. But certainly for the time being, it feels like the next 3 meetings, they're going to be cutting interest rates. So certainly a significant decline in interest rates expected from the BOC. And so we've already moved. God, this is twice this has happened now. Okay, fine. So this is the chart I wanted to show you guys, and it is the CAD against the Swiss franc. And what was really cool about this was we had this head and shoulders formation, right? And you've got this sort of long-term downtrend. So for me, I thought it looked like we were going to sort of break lower from here. That's exactly what has happened because we took out the neckline already from this head and shoulders formation, with the neckline around about here up to here. That kind of zone, 626 kind of area. Little bit of consolidation. Now we've seen this sharp decline. Nonetheless, I mean, ultimately, it's got to go somewhere from here. So what we're looking at, well, we've got this really interesting area of support, which plays in with this low down here, the lows around here. And so, yeah, it pretty much all tallies up at 619 here. So near term, we do have support. We could provide a little bit of a rebound, but certainly there's a good chance that some consolidation or retracement comes around here, and then we possibly see the pair rolling over once again. Canadian dollar showing signs of further weakness, and like I said, with the fact that the Swiss are moving towards a period where they soon enough are done with their easing cycle, that could provide the basis for strength for the Swiss franc. Hope that's been useful. Apologies for some of these charts. I've been waiting for essentially the payrolls release to come out to make sure that we don't sort of create a video that's out of date before it even gets uploaded. But ultimately, we've seen some of these moves playing out already. But certainly key markets to be looking out for in a week that certainly is going to be dominated by central banks, but also that inflation report coming out of the US. Thanks a lot, guys.